This is Pablo Lucina from Masters in Trading. In front of you, I have our Metals Edge product. It is just the outright component of it, as can be seen right up here. We're labeling all the products precisely for that reason, to make them easy to see. Okay, so why am I here today? I am here today because something very interesting is taking place in the marketplace. What I have plotted here are gold futures in blue. This blue line, this blue label that you see up here represents this blue line, and correspondingly this blue line up here and this blue line down here. These are the implied ranges. These ranges move up and down based on implied volatility of gold. As can be seen here on the screen, gold's implied volatility is currently at 16.29%. What's interesting about this all is the fact that we have gold about to test its upper range, and implied volatility is not moving. Let me take you back to the beginning of the year. Gold, again, the blue line, was rallying a little bit, and when it started to rally, as the market started to sell off, and even before then, even before we had the big sell-off, notice that whenever gold attempted to rally, its implied volatility, the implied volatility on gold, each time that it would rise, gold rise that is, its implied volatilities would also rise. What that told us back then was that the risk in gold was to the upside. I mean, and for comparison, after gold, really took off, its implied volatility, as you can see, very, very, very much took off, to the point where it never actually touched it. Yet here we are, approaching it, and it's coming off. It's heading lower. To me, what this means is that gold could very easily pierce through this implied range and continue heading higher. In essence, what I'm saying is that what appears to have happened in gold is that people or firms and institutions are more afraid of gold selling off than they are of gold continuing to rise. Now let's move over to silver. And where is silver? Silver is our trusty yellow line. So here's silver. Silver is this yellow line that you see here, and likewise it has its label right up here. And we can see that the implied volatility of silver is 33.59. That's up 2 percentage points from the beginning of the day. And currently silver has gone up by almost $1,000 on the day. But that's not the important part. The important part is that silver has managed to come and trade above this zero line that had been giving it so much trouble. Notice what happened in the past during this year, May 18th during this year. It tagged the zero line and rejected. Here it got above the zero line, but it came back down. And ever since then, pretty much for the past month or so, a month and a half, we've been trading around the zero line or below the zero line. Well, now we're above it. Okay? And what is happening to the implied volatility of silver? The implied volatility of silver is rising. What does this tell you? What this tells us is that the risk on silver is to the upside. Firms or people with positions in silver will hedge, the market will get volatile as silver rises. And we are seeing this today. And notice that gold is also rising, as I just showed you. Silver is also rising. But the implied volatility of silver just went above that of gold's. You may be asking, why do I have these two strange lines here? I have this this line that is a brownish color, and then I also have this other line that is a yellow color, and they have dollar values. This one says $4,430. This one says $7,753. Why are these so important? I'll show you why. I'm scrolling back to the beginning of the year, January 1st. This, the brown line is drawn here because the S&Ps, the S&P futures, when they rallied before they had their their big sell-off, this is where they stopped. That was the top. That brown line represents the top. So if you bought an S&P future on the very first day of the year, right before the sell-off, your profit was, $7,700. If you just held it, that is. And what's interesting is that gold reacted to that level as well, way earlier. That's interesting. Not only did it react to it, it also used it as support afterwards. Again and again. These are two completely different assets. I'm talking about the S&P futures in brown and gold in blue. But yet somehow the S&P future top has some interplay with gold. Likewise, with the yellow line, the reason why it's drawn here is because that happened to be the top in silver during the year. Earlier in the year, when silver was rallying, this is where it got to before it sold off. Okay? And as we can see, throughout the year, it's come close. It went above the zero line. It came close, but then it went back down. So right now, we're above the zero line. That's check mark number 1. Okay? We're above the zero line. That is a positive. Check mark number 1. We're above the zero line. Check mark number 2, which right now is really a question mark, would be what happens to silver when it comes up here? And how do you know where silver is at right now? Silver is at $1,700. And how could you see that using the charts? Just expand it out a bit. Here it is, 1,700. And we can see that the S&P futures are negative 3,425, away from the zero line. Meanwhile, silver is 1,700 above the zero line. So keep this number in mind. Okay, I'm not done. I have more juicy stuff for you guys. Let's cruise over to a website that I have no affiliations with. I just happen to have a subscription to them because they have really interesting data about gold and silver. All right, so here we're at. I am not affiliated with this website. I just use it and pay for a subscription. They have all sorts of data on gold and silver. As you may know, the silver and the gold and the platinum futures that we trade are traded under the name of COMEX. This is owned by CME Group. So what happens with these silver futures is that very rarely do people actually take them into delivery and pretty much stand in line and ask to take physical delivery of silver. Mind you, one future contract, just one, is 5,000 ounces of silver. One future contract, 5,000 ounces of silver. We do the math on that. With silver, let's say, 18.5 times 5,000. That's roughly 100 grand. With gold, the current future price is 1807 or so last time I checked. However, the gold future contract is 100 ounces rather than 5,000 ounces. So we're looking at about $180,000 of value, if you will. Even though this one only gives us 100 ounces, since the price per ounce is $1,807 for gold versus the silver one, which we did here earlier, as you can see, is 18.5 times 5,000 gave us 92. This is roughly speaking a 2-to-1. It takes two of these silver futures to equal one of these gold futures, but that is not the case. It's just that the prices are so out of whack at this time that we're seeing such giant discrepancies. In this web page, what we can see here, I am looking at data just from 2018 up until today. And this is for COMEX warehouse silver deliveries. Note a few things. You see this big bar right here? Stopped contract deliveries. What this means, stopped contract, that means people that have long contracts that are pretty much saying, hey, yeah, I'm going to hold this contract until delivery and I want my physical silver. So let's go back in time and let's check to see when something this big has happened. Let's say in the past 5 years. Boy, that line looks awfully big. Let me zoom in. So over the past 5 years, this goes back to 2015, and over the past 5 years, you can barely see it because it just happened, but this was approximately 13,000 contracts. 13,000 contracts. If we go back to the calculator, 13,000 contracts times 5,000 ounces each. That's 65 million ounces of silver. Multiplied by its pretty cheap price today, that's roughly $1 billion, $1.2 billion. It may seem like a lot of money, but in the finance world, that's really peanuts for these big banks. The important thing is not the dollar value. Okay? The important part, let me divide by 18.5 to get back. The important thing is this. 65 million ounces of silver in 1 day need to be delivered. Let's keep looking. Notice anything strange about the open interest? It dropped off the map earlier this year. Let's zoom back into a 6-month view to get a better view. So we saw open interest start to drop off. From February to March, obviously there was the pandemic going on, and it stayed low, started climbing back up, but after this ginormous bar of deliveries happened, open interest has been on the decline. All right. This second section here, it shows us the cumulative stopped contract deliveries. It adds them up. So here's the 13,000 that I mentioned, and then plus this one, plus this one, plus this one. And it's showing us that they continue to rise. We're a bit away from 15,000 silver future contracts that need to be delivered. Again, this is using that 6-month view. Let's go all data just to see the monster that we're facing. Again, you could barely see it because of how big it was. It is. That right there is the biggest single day of deliveries that has ever happened. And this data goes back to 2006. It just so happened that in 2006, a bunch of ETNs and a bunch of ETPs and ETFs were created. Okay? Now, is this just a silver thing, or is this also a gold thing? No, it's also a gold thing. And a platinum thing. Alright? I changed the gold. I'm over here in all data. And, I mean, the only time that comes close to this in gold was back here in 06, near the financial crisis, as you can see. But there's massive amounts of traders that want their gold, and they no longer wish to keep it within the COMEX warehouses. Something funky is going on in the gold market, and the silver market, and the platinum market, and all these other markets. Equity Edge, Metals Edge, and all of our other suite of tools can help you navigate through these potentially turbulent times ahead. I hope that this video has been informative and worth your time. Thank you.